Oh man, has Jerome Powell just cancelled our interest rate cuts? We can see here that markets continue to be volatile. We just got some new macroeconomic data which throws a bit of a spanner in the works. In this video, I'm going to break down exactly what that macro data means. Does it now reduce the chance that we get an interest rate cut? And what does it mean for the Bitcoin price? Loads to get into and a lot more. I'm feeling a little bit under the weather, but you guys know that's not going to stop me from giving you guys the updates. If you appreciate that, smash up the likes. Do not forget to subscribe. Let's get straight into this one. You can see that Bitcoin is in a consolidation pattern. Friday, another red day. What was the catalyst behind this red day? The main factor here is March US payrolls beat expectations. Remember, I told you on Friday we were getting the non-farm payrolls. They came in at 303,000 new jobs. Now, why is that an issue? I mean, obviously you can see it's a skyscraper tower here on this chart, but the estimation, what the markets were expecting, was 200,000. That's a very, very big beat. But why is it that good data is now bad data for the markets? That's something we need to understand. Remember, this market, the risk on market, the crypto market, the altcoin markets, us guys who want crypto to pump, we want Jerome Powell to deliver an interest rate cut. We want him to move away from being tightening, where he's hoovering up money from the economy, to now being loosening, when he's our friend. And when he's our friend, what does he do? He prints money, he loosens, he stops tightening the noose around the neck of the markets, and instead, he's trying to resuscitate the market. But in order for him to do that, what does he need to see? He needs to see that there is a meaningful wound in the market. He needs to see that these high interest rates, where he's hiked all this way, the steepest rate hikes we've had in a very long time, is taking a burden on the economy. And when he sees it starting to take a burden on the economy, that is when he will start doing the rate cuts. Now, what did he telegraph? What did he told the market towards the end of last year in the summary of economic projections, the report which we went through here on this channel, is that most likely he was going to do 3 rate cuts this year. 3 rate cuts. And so the market scurries to price that in, right? The market gets excited, we're like, oh, look, we're getting 3 rate cuts this year. But the problem now is we're starting to get data come in, real live macroeconomic data. And it started earlier this week when the ISM manufacturing data came through, right? I made a video, I know it's complicated, I explained it to you guys saying, look, guys, this is not good. This is showing that the factory output in the US is high, right? And remember, good data is bad data, because if the economy is doing well, no rate cuts for us. There's no point, right? Jerome Powell doesn't need to do rate cuts if the economy is healthy. So that's really, really important. And so we've just backed that up with another healthy jobs report. 303,000 new jobs, more new jobs than expected. But there was a saving grace in this report, which I'm going to cover off as well. Now, if you appreciate the updates, please smash up the likes. Do not forget to subscribe. I'm completely out of it, but I've got to give you guys these updates. If you want to trade with us, jump into our Telegram community, ijazcrypto.com/TG. If you want to buy or sell any tokens, you guys can check out the links to Bybit, Mexi. Those guys support the channel, so please do help them as well. Check out the links in the description. Okay, now, when you dig into the number, there's another number you need to look at, which came and saved us, and that is the average hourly earnings. Without this number, this day yesterday could have been much worse. In the end, you can see what happened yesterday, right? The market fell as low as 66,000 and then recovered to close the day at 67.8. Why? Because the market took the headline figure, 300,000, and they panicked, but then they started delving into the report and understanding that, hang on, there is a saving grace. And that's what I'm going to explain right now. So if you take a look at this, the average hourly earnings, wages, grew 4.1% year over year. More importantly, this is the lowest figure we've seen since June of 2021, right? 4.1%. Look at it. It's much better than all the figures we've seen previously. Now, if you're creating more jobs, that's fine. That's a good thing. People are in jobs. The reason people don't like it is they go, oh, look, more jobs, a hotter market could create higher wages. And we've spoken about this before on this channel. I know it's a bit complicated for the average newbie in crypto, but that's what this channel is about. I'm not here to be a moon boy. I'm here to actually show you what matters. I'm not trying to get millions of views where Bitcoin's going to 100,000, let's all jump in now. No, I want a few people that are serious about learning how to navigate this market. So if that's you, make sure you're subscribed, because I'm going to keep bringing this data. So when you look at this data here, this is saying that, oh, look, the labor market can create more jobs, But at the same time, wages can go down. So there's no necessity that there is an inflationary pressure, which is really positive. Okay, so I need to recap that. You can have more jobs. This number can be high, which spooks the market, right? But when you look into the rest of the report, wages didn't follow. And if you look over the month-over-month wages, that came in at expectation as well. 0.3 versus 0.3 expected as well. So when you look into the detail, you're like, okay, this is actually interesting. Because what these bits of data suggest, if this continued every single month, is that you're actually getting a soft landing, which is where inflation is coming down, right? Let me show you the chart of CPI inflation. You can see that inflation is starting to kind of trend down here. We're sitting at 3.2%. Gone are the days, where we were in really horrible figures all the way up at 8, 9, etc., right? We've come down all the way from 9.1 in June of 2022. We've kind of stagnated a little bit, but we've managed to do that without breaking the back of the labor market. And the manufacturing with the ISM data I shared with you earlier this year. So from Jerome Powell's perspective, if the economy is healthy, why do I need to cut interest rates? The market's doing its thing. It's healthy. And so that is what's now starting to spook the risk on markets again. Because if you take a look here, markets had not expected one in May. The May FOMC meeting, the market already ruled that out. It was the June one. In June, this was as high as 60 to 70% of the market was starting to price in that we would get our first rate cut. Because remember, we were expecting 3 this year. So you kind of wanted to start by June. But now that started to shift. With the data we've seen this week, it's started to shift down now to 50%. And so now it's almost 50-50, where half the market is going, okay, maybe we will get a rate cut. And half the market is like, nah, I don't think we're going to get a rate cut. This economy is too healthy. Now, we need to focus on the more important piece of data, which is the next release we're going to get. Okay, so on April the 10th next week, we're going to get the next CPI data. We're going to get the next bar on this chart, right? And that's what we need to pay attention to. Where is this next figure going to go? The market is expecting 3.4, right? So as long as we follow what the expectation is or come in lower than expectation, that's going to be a good sign for us bringing inflation to the downside. Now, interestingly, you want to make sure that that is coming down. If it's not coming down, Jerome Powell has a reason to keep interest rates high. And God forbid, if you jump on over here to CNBC leading with this article, Fed Governor Bowman says additional rate hike could be needed if inflation stays high. So we need to keep this into perspective. Markets, as of this, throughout the first half of this year, had priced in 3 rate cuts. Now, it doesn't matter where they price it in, June, September, wherever they price it in, doesn't really matter. But they priced it in. They were expecting it this year. So now the question is going to be, how does the data come in over the next kind of couple of weeks, the CPI data, the PPI data? And therefore, does the market go, hang on, are we going to get not 3 rate cuts, but maybe 2? Or are we going to get 1 this year? And based on that probability, they will have to start pricing that data in. But remember, if you're expecting less rate cuts, that typically means more red in the market. Now, again, there is a saving grace. I want to break this down for you. There is a saving grace, but generally that would be red. Now, of course, if then Jerome Powell comes out with a surprise rate, another rate hike, instead of the cuts we were expecting, that is going to be a complete rug pull. That's going to be painful here in this market. Now, very important that we add this nuance into the conversation. Bitcoin, throughout the bear market, has been very, very correlated to the traditional markets, following this data that we just discussed here. But we have to understand that there are a few more nuances to the current mood of Bitcoin that doesn't solely rely on the traditional markets. So yes, looking at the traditional markets, looking at the trajectory of everything we just discussed there in terms of are we going to get rate cuts is going to be really important for Bitcoin and really important for altcoins. But on top of that, Bitcoin has its own narrative as well. Okay, we have the Bitcoin spot ETF now in its fourth month of trading now. We're starting to see inflows really come in and starting to have an impact on the spot market. We're also very, very close here in April to our Bitcoin halving, a fundamental pre-programmed event that reduces the Bitcoin block rewards by half. These are things which move Bitcoin separately to the traditional markets. So it's not that we have to move exactly with the traditional markets. It will have an impact. We've got to add it into our calculations. But Bitcoin does have the ability to decouple and move of it on its own accord. So it's very important that, whilst we study everything here, we take this We understand exactly what it does. We also understand that betting against Bitcoin is like betting against a freight train when you're heading towards a Bitcoin halving. So for me, yes, I'll look for more pullbacks. I'll look for more pain. I mean, if we get a horrible CPI reading, then I sit here at the weekly chart and go, okay, can we get a bit more of a pullback? Right? Can we get some pullback action? Can we come work our way towards 60,000? Great, I'll take it. Right? We spoke about this in a previous video as well. Will market makers continue to try to shake you out of your Bitcoin just before a Bitcoin halving? If people get shaken out, I'm buying. I want to be nibbling the closer we get to this weekly EMA ribbon. Maybe we won't get those buys. We're ready in our daily EMA ribbon. For me, on a daily chart, nice areas to be buying, right? In a daily EMA ribbon, I certainly don't want to be chasing at 74,000, but buying, like we were at yesterday when you're touching 66,000, nice little cheeky buys, right? Buying when the market is fearful. That's really, really important. So overall, we're in a very precarious position, which I don't think a lot of the crypto participants are understanding from the macro perspective. But that being said, let's not forget the fact that Bitcoin's heading to a halving. It is ultimately a bullish year. At some point, we still expect to get some rate cuts, even if it's 1 or 2. Hopefully the data starts improving. But even then, longer term, the fact that the traditional market is starting to exhibit signs of a soft landing, dare I say, that's also a positive. It means maybe we can avoid a multi-year recession. Maybe. Right? And that's going to be really positive in terms of the bigger cycles of how can Bitcoin continue to have a nice, long, extended bull market if the underlying traditional market remains healthy and risk is rotating on. Because ultimately that matters. Right? Ultimately, whether we like to talk about the halving, we like to talk about all the other things, we need the market to be risk on. We need people to have excess money in their pockets, not paying too much for their mortgage rates, not paying too much for their car lease. They've got an extra, bit of income coming in that ultimately they can put into risky assets. They can go, I want to take a risk and buy some Bitcoin. I want to add to my altcoin portfolio, right? If they have no money and they're super tight and the market is really, really in a tough situation, very, very tight from, Jerome Powell and the rest of it, then it's hard. So it's important that we're able to balance both of those aspects here in the market. So there you have it, guys, a breakdown of the macroeconomic data and what it means for this market. Be very, very prepared for more pullbacks, right? This data does show both sides of the argument. So be very, very prepared. If you appreciate the type of content, smash up the likes. Don't forget to subscribe, and I'll see you in the next one.